Hi all, this is Akshara Menon from PMS Bazaar. A warm welcome to all of you joining us in today's webinar on building resilience through certain times. In today's fast-paced and often unpredictable market environment, resilience is the key. And that's exactly what we'll be focusing on today and how to build a sustained resilience in an investment journey. Before we dive into the movement, into the content, let me share with you the few topics that we're going to explore for the day. We will start with global dynamics. As you know, all that global markets increasingly influence the local ones. We will provide the insights into the international context for Indian investing. We will discuss on how global trends and events can impact your investment decisions and strategies. Next, we will tackle the challenges of finding value in the overheated market, with market valuation soaring, discovering the undervalued opportunities requires a key eye and a strategic approach, which we'll be discussing in detail. We'll also explore a age-old debate, which is concentration versus diversification. Understanding when to concentrate your investments and when to diversify can make all the difference in both preserving the capital and maximizing the returns. Finally, we'll dive into the fascinating world of wealth creation by observing the behavioral changes, understanding the investor's psychology and market sentiments can reveal the shifts that lead significant investment opportunities. To guide us through these topics, we are privileged to have Mr. Balaji Vaidyanath, a Chief Executive Officer and Chief Investment Officer at NAFA AMC. With 2 decades of experience in equity markets, Balaji's journey started as a research analyst before moving into the portfolio manager at Sundaram Asset Management. His impressive track record as a fund manager for Sundaram Portfolio Managers, where he outperformed the portfolio benchmark by over 100% across diverse strategies, speaks volume about his expertise. At NAFA Asset Managers, under Balaji's leadership, the firm has built a solid foundation that prioritizes high conviction, lengthy holding periods, low churn, and a steadfast approach during challenging market phases. He currently manages nearly over 450 crores in asset, including advisory services, bringing a wealth of knowledge and experience to today's discussion. With that, I'll hand it over to Mr. Balaji to take us through the session. We are excited to hear the insights from you, sir. Before that, I request the participants to put their questions on the Q&A box and not to ask any stock-specific questions. Over to you, sir.
Hi Akshara, good evening and thank you for having me here at PMS Bazaar and a very warm welcome to all your PMS Bazaar investors and participants. It's a pleasure to interact with all of you. So NAFA Asset Managers, we are a SEBI registered portfolio management company. We've been in the business for almost 9 years and we are a team of 10 people. We are domiciled across 3 geographies, including Chennai, Mumbai, and Delhi. And our what we believe our strength is the mid caps and small caps in terms of the categories of market that we are present in. And our flagship fund is the NAFA Emerging Blue Chip Strategy. In March 2025, next year, it will complete 9 years of track record. And this fund has seen multiple cycles, including the the boom phase during 2017, and then the trade war and ILFS DHFL crisis phase during 2018, followed by COVID in 2020, and the Russia-Ukraine war starting in the end of 2021, and so on and so forth. So we've been able to deliver meaningful returns to our investors. So the endeavor here is to share some thought process in terms of what we do, how we do, and how we look at markets, etc. So in this process, I will be obviously sharing some stock examples. Of course, needless to say, we may or may not have positions in those companies at this point in time. It is purely for illustrative purposes. It's not definitely a recommendation. It is just to kind of explain our thought process in terms of trying to convey what we do and how we do. So I'm just sharing a screen. When you trust the process, the results will come into come into play, the results will work for you. This was, of course, inspired by the legend Mahendra Singh Dhoni. NAFA itself means profit, munafa, nuksan. Nuksan means loss, NAFA means profit. That's the Parsi origin word. So NAFA Asset Managers, trust the process. So, this is headed by myself, and it's ably helped and assisted by my dear colleague Sendilnathan, who's been with me since inception as a co-fund manager in this particular organization. So I'll just quickly jump into what we do, how we do, etc. So this presentation is not too much of macro. We are not talking too much about GDP growth and inflation and so on and so forth. These things we read about it most of the time in various media. So this is as micro as possible. So we follow a three-pronged approach when it comes to stock picking. The first approach is what we call as the capex mispricing approach. So here, we try to buy those companies which are currently undergoing huge capacity expansion. So the revenue potential of these companies over the next 2 to 3 years can be 2 to 3x of what it is at this point in time. So mind you that capex for the sake of capex is not something that we are looking at over here. So capex done by those companies which are operating in product categories which are growing at least 1.5 to 2x the nominal GDP growth of the country. So what do I mean by that? Right. So you're having a 7% real GDP, and then you have 5% of inflation. So which means that your nominal GDP is about 12%. So industries and categories which grow at 1.5 to 2x the nominal GDP, which is about 15 to 20%. This is something that comes into our radar, and companies which are doing capex in these categories is something that we prefer, in terms of our capex mispricing stories. So why does this happen, right? So we are talking about companies and industries growing above the nominal GDP. So when you say that the nominal GDP growth is say 12%, there are industries which grow above the nominal GDP, and there are industries which grow below the nominal GDP. And sometimes you can find answers for that. One of the main answer is that the changing preference and taste in the Indian consumer. So in 2008, we were a $850 per capita nation. So today we are a $2,500 per capita nation. So the Indian is slowly getting richer. When he or she gets richer, he or she doesn't do certain things they were doing when they were not so rich. So the taste and preference changes. The way they consume entertainment, the way they consume food, the way they travel, the kind of preferences that they give compared to say 1.5 to 2 decades back, all those things change. So in that process, there are some winners, and these winners typically grow greater than nominal GDP, and there are losers, and these losers typically grow below nominal GDP. So our focus is obviously trying to observe this human behavior and try to see those categories which are growing above the nominal GDP, and those companies which are doing capex in those particular industries. So that is our first part of the three-pronged approach. The second part is the market share gain and the consistent compounders. So again, it's very similar to the point number one. Only thing is that within industries, you might have different fortunes for two companies. So company X, due to its better leadership or better product range and distribution and logistics and so on and so forth, can be gaining a significant market share vis-a-vis company Y, which might be losing market share. So typically the market share gain is rewarded disproportionately in the markets. So we always keep looking for such companies where there is a consistent market share gain. So for example, if you look at Safari versus VIP Industries over the last 2 years, when Safari gained a significant market share vis-a-vis VIP Industries. Similarly, KEA Industries versus Finolex Cables, where KEA significantly gained more market share compared to Finolex Cables. So this is what we do in our second approach. The third approach is the special situation and the temporary headwinds kind of a situation. Businesses are never linear, right? So you're always going to have ups and downs. So Indian markets are extremely dichotomous. So Obviously, not only Indian markets, but generally, if you look at it, if you want certainty, then you end up paying a very high valuation. So, for example, Nestle, we can say with great certainty that this company can generate a 3,000 crores of cash flow next year, Nestle India. But we end up paying 100 times. So we have to pay 3 lakh crores to buy Nestle India today. So it's a 100 P multiple. Uh, but if you want valuations to be in your favor, then we deal with some uncertainty. So that uncertainty is not something which is unsolvable, but these are certain temporary issues which can get resolved over, say, 3 to 6 quarters, or sometimes 4 to 8 quarters, post which, things revert to normalcy. But initially, your valuations are available at throwaway prices because of the current existing problems. So that really offers an attractive, entry opportunity. So this is our three-pronged approach. So if you look at the portfolio mix, it is about roughly one third each in all these three categories. In terms of capex mispricing, we have about 30%. Market share gain and consistent compounders, we have about 34%. And special situation, temporary headwinds, we have about 30%. Now I am jumping straight into certain examples. Like I said, these are just examples. We might have pruned positions. We may not have the same view that I'm explaining to you now. So these are just for illustratory purposes. So one of our top picks, which worked really well for us, over the last couple of years, is a company called Heritage Foods, which fell into our special situation bucket. So this company is a mid-sized dairy company which is with a very strong foothold in Andhra and Telangana, followed by Tamil Nadu to some extent. And this company has two parts. One, this company went into retail business, and they were bleeding money in the retail business. They were making losses. By the time they got rid of the retail business, they found a suitor for the retail business. The suitor himself went bankrupt, and this company was in a bit of a soup at that point in time. So the valuations were next to nothing. There was a lot of investor apathy towards the stock. So what actually triggered us to look at Heritage Foods was, of course, the management change. There was, of course, someone from someone who's worked for Coke, and someone who's worked for companies like Olam International, joined this company sometime in 2021. And with Heritage at that point in time had the lowest share of value added products, and compared to other dairy companies. So the mandate here was to kind of increase the value added share component as far as the company is concerned. And the company also offered rights issue sometime during Jan 2023, right? So we are talking about skin in the game. So a promoter can essentially do two things, right? So one, he can buy his own company or increase the stake in his own company, or he or she can sell his or her company. So typically when the selling happens, the selling can be for multiple reasons. Selling can be for profit booking, selling can be for allocating into some other private business of the promoter, or selling can be for family settlement, or selling can be for charity. And there can be a host of reasons for selling. But when the promoter actually increases stake in the game by buying, it is typically 90 to 95% of the time it's only for one reason, which is that the promoter is seeing better times in the business. So rights issue was typically a giveaway in terms of the intentions of the promoter and what they are seeing from the point of view of what could happen in this company. So our entry point was somewhere there. We got into this company uh, around Jan 2023, and we waited for some time. And initially, this company had certain issues, right? Because they had very low share of value added products. You could see that their margins had actually come down, from 6% to 5%, 4% kind of levels. The margins had actually plummeted. So they were losing margins because they had very low share of value-added products. So once the margins plummeted, the stock fell even more at that point in time. So there was still a negative reaction. In fact, even after we bought the company. Uh, Meanwhile, the company actually increased the promoter stake from 39% to 41%. So they have actually increased their skin in the game as far as the business is concerned. So they've increased their promoter stake. So we continue to add at various points, right? So both buying and selling, there is never one price to buy and one price to sell. There are multiple ways in which you can buy, multiple entry points we obtained, and therefore, we bought at various levels. Uh, then, the company, if you look at the recent quarter numbers, as the share of value-added products kind of increased, it is still not to the tune of the leader, but somewhere, they have increased. So from a 5% EBITDA margin level, they moved to 7%, and from 7%, they moved to around 9%. So, a quarterly EBITDA run rate 2 years back was around 650 crores, and today the quarterly turnover was around 650 crores, and today the quarterly turnover is about 1,000 crores. Uh, so not only has the sales grown, the margins have also expanded, and therefore we saw a significant re-rating in the counter. Of course, this is not specific to Heritage. We also saw a similar thing play out in something like, say, a Dodla Dairy over the last 18 months or so. But we picked Heritage because it was available at a slightly cheaper multiple than even Dodla at that point. So we have heard about the P multiple. So idea here is to kind of showcase how so investing, there is always this tendency to kind of look for high growth, etc. So here, it's kind of breaking the myth. You're trying to say that even balance sheet based investing can give you those high returns. It need not just be P&L based investing looking for growth. So we've just done this exercise to try and showcase how this works, where what we have christened as the debt multiple in Indian markets. So if you so what we have actually done here is that the average 2-year price CAGR of large cap, mid cap, small cap, we have put three categories here, large cap. So look at the average at the most right side of the column. So average 2-year price CAGR when debt is repaid. So when minimum of 5% of debt is reduced um, over 2 years, this is how the stock price behaves, right? So you have a 22% CAGR in a large cap, you have a 29% CAGR in a mid cap, and you have a 26% CAGR in a small cap. So just by not growing, but if you just reduce your debt, the market is rewarding you significantly. So uh, so this is how it ends up. So enterprise value as an equation, we all know that is basically that it's market cap plus debt minus cash. So for the sake of simplicity, we are removing cash. So let us say that the cash is zero. So enterprise value is market cap plus debt. So if 100 rupees is the market cap and 100 rupees is the debt, the enterprise value of the company is 200 rupees. So if the debt gets completely repaid, so does it still become, does the market cap go to 200, or does it go more than that? So we are seeing that the market cap actually goes beyond 200. So which means that there is a debt multiple which the market gives. So in a large cap company, if the debt is repaid, the market cap doesn't go up by 1x, it goes up by 1.4x. In a mid cap company, if the market cap doesn't go up by 1x, it goes up by 1.6x. And in a small cap company, the market cap actually goes up by 1.8x. So if 1 rupee of debt is repaid, there's 1.8 rupees of market cap which gets added. So just as an illustration, so 10,000 rupees debt on year one, year two you have repaid 1,000 rupees, so 9,000. Year three you have repaid another 1,000 rupees, so 8,000. So your debt reduction is about minus 10.5%. Whereas if you look at your market cap, we are looking at a 1.8x market cap return. So which means that your debt is reduced by 10.5%, but your market cap increases by almost 20%, 19% to be precise. So we keenly watch those companies which are repaying debt as well. So it's not as if that you can make money only via P&L investing. So the balance sheet and cash flow is rectified, value creation is made. So similarly, coming to the P&L part of it, we have also dissected the sales and EBITDA margin relationship, something that we closely track every quarter. So we have just made it into 4 quadrants. The first quadrant is sales greater than 5% and consecutive EBITDA margin expansion for 2 years. That is the first quadrant. If you look at the average returns, it's about 29% for large cap, 48% for mid cap, and 51% for small cap. The second quadrant is sales is greater than 5%, and there is no EBITDA margin expansion over 2 years. So this is the second best scenario. So in this instance, the returns are slightly lower than the first quadrant. Large cap is 21, mid cap is 25, small cap is also 25. This is the third quadrant where sales is actually less than 5% and EBITDA margin, they have shown some expansion in EBITDA. So large caps have grown by 38%, mid caps have grown by 17%, and small caps have grown by 23%. This is the fourth and arguably the worst quadrant where sales has degrown and there is no EBITDA margin expansion over 2 years. So the average large cap stock has given a 5% return, average mid cap stock has given a 2% return, and average small cap stock has given a 7% return. So this is the index, right? So index has given about 11% on Sensex, and mid cap has given about 12%, and small cap has given about 13% index during the same period. So these are the 4 quadrants that I mentioned. The index column is the same for all the 4. So this is the first quadrant where you get the best returns. This is the second best quadrant. This is the third quadrant, sales less than 5% and margin expansion. And this is the fourth quadrant. So what does this mean? Does this mean that we don't buy any companies at all in the fourth quadrant? Yes or no? Or do we only stick to the first quadrant where there is both sales and margin expansion? So again, the point here is that you can still even buy a company in the fourth quadrant provided the price is favorable for you. Meaning that if the first quadrant companies are trading at say 1x, say the first quadrant there is a large cap company that has shown sales growth and margin expansion and it is available at say 50p, for example. So in my fourth quadrant, I can still go and buy a company if I get that company at 0.17x of the first quadrant. So which means that roughly 10p or 9p. So if I get a 50p company in the first quadrant, and if I get a company at 9p in the fourth quadrant, I'll be indifferent. So there is no question of chasing growth, or there's no question of chasing only quality, etc. Because everything has a price. So there's no virtue signaling. There's nothing which says that is a good quality management, good quality promoter. Nobody is a saint. Nobody is like I said, every saint has a past, every sinner a future. So you look at a company with no sales growth, no margin expansion, but still if it is available at a extremely throwaway price, you can still make money out of it. So this is the example, right? So your initial investment is 100, you get a 29% CAGR. So your end of the year value is about 129. So without margin expansion, that is the second quadrant example, your initial investment is 100, so you make a 21% CAGR, so your end of the year value is 121. So what price should I buy the second quadrant company so that there is no difference between my first quadrant return and the second quadrant return? So when you do a back working of that, if I get the second quadrant company at 72 rupees per share instead of 100 rupees per share, I am indifferent between the first quadrant and the second quadrant. So everything has a price, and that is what we generally focus on. Moving on to another example in terms of my second example of consistent gainer is Just Dial. Again, this company is something that we picked during mid of 2023, and of course, this company had came out of COVID, and they had a very bad COVID phase. They in fact reported loss at the EBITDA margin level during 2021, etc., understandably. But what we were witnessing is there was a significant recovery in the margins over 3 quarters. So from 8% it moved to 12%, from 12% it moved to 14% in March 2023. Our entry price was around 688, and the market cap then was about 5,870 crores for this company. So this company was also changing its business model. They were coming out with an app, and there was always question marks about this company's future with the entry of Google and so on and so forth. But they were also changing their business model, and most importantly, that this company, the kind of cash that they had on the balance sheet of almost 4,000 crores. So the market cap of the company is 5,870 crores, and they had uh, cash on the balance sheet to the tune of 4,000 crores. So which means that if you net off the cash, you are getting the company at about 1,850 crores, and you are getting an operating profit of about 130 crores. So 130 crores on 1,870 crores, we are talking of a 7% cash flow yield roughly. So typically in an era where tech companies are known to report more losses and they are on a constant kind of an investment phase, etc., we have seen a situation where this company is reporting profits, very good operating profit, and the profit looking to expand. And that has also kind of played out. So if you look at the recent quarter numbers, we have seen that the EBITDA margins for Just Dial have not only, it has continuously expanded from 14 to 15 to 19 to 23, 26, and currently 29%. So it's like almost an all-time high kind of an EBITDA margin. Whereas, you were able to capture it at when the company was doing just half the margins. So this is like a temporary kind of a headwind at that point in time. But the company could kind of revive, and the valuations that you are paying was next to nothing because the company had a significant amount of cash. So the balance sheet was extremely strong, and they had very strong growth in their operating profits basically. So since our buying, the stock has then kind of moved up. So it's almost doubled. Yeah. So what are some of our recent entrants? We bought a company called Castrol in 2024 February, and we also bought Mayur Uniquoters in 2024 March. Castrol is obviously is into the business of lubricants, and it's supposed to be a sunset industry. Once EV comes into play, what is the use of lubricants? Lubricants will completely move away, and so on and so forth. This was like the general perception, and the stock was underperforming for a long period of time. It was throwing significant amount of cash, and they were paying a significant amount of dividend. The dividend yield at one point in time was close to 5-6%, and they were growing at about 3%. So our entry point was around 200, and since then the stock has done about 260. And this is in a so-called sunset industry. It's an industry where the belief was that there is no future in it. So, but why did we buy Castrol, right? So, what happened to Castrol? It's a story of two parts. Initially, they were growing at about 9%. The sales growth was 9%, and earnings growth was around 12.5%. So this was between 2005 to 2015, and you had a situation where the company, you must have seen a lot of MNC companies where the MNCs are reducing stakes, like Whirlpool, for example, Timken, for example. These companies reduced stakes recently in their Indian listed entities. But in the case of Castrol, their parent, British Petroleum, BP, they had global issues way back in 2016 itself. And globally they sold a lot of assets, including their stake in Castrol. So they brought down their stake from 71 to 51%. So, and at the same time, one of their competitors called Gulf Oil got listed. And Gulf Oil was very aggressive from the point of view of trying to capture market share. So Castrol, then, the sales growth plummeted. It actually halved from a 9% level to almost 4.5%. Earnings growth was 12%. It plummeted to almost 4%. So there was fear of rise in electric vehicles, lack of volume. So everything was extremely, gloomy. And then what changed? So, so there is this taxi rental company called Hertz globally, which is a $1 billion market cap, mainly in the US. So Hertz at one point in time announced that they will be going entirely into EVs. They'll convert their entire fleet into electric vehicles. This was way back in 2021, and it was that point in time that Tesla hit a $1 trillion market cap. And this company in 2023 came back and said that, look, we are going to downsize our electric vehicles. We have about 50,000 electric vehicles. We are reducing it by 20,000. So we are selling 20,000 electric vehicles. Why do you do that? Because you are mentioning that you're going to go 100% into EVs. Then they say that there are a lot of hidden cost of maintenance for electric vehicles. The electric vehicle, given an electric vehicle and the ICE, internal combustion engine car, the electric car weighs about 30% more than an ICE car. So the electric car, the weight of an electric car is 30% more than an ICE car. So the tires wear out faster. That is point number one. Point number two, the battery life is not as long as expected. And the OEMs like Tesla themselves were reducing the prices of the first hand cars, thereby making the second hand market redundant for EVs. So, this means that the terminal value problem which Castrol suffered from, maybe it's not there so much. Maybe people opt for hybrids. We don't know. The answer is not out yet. So, so now the company has become extremely aggressive. They have Castrol, if you look at it, has hired brand ambassador like Shah Rukh Khan. They are now sponsoring the Mumbai Indians team, and they want to regain the lost market share from Gulf Oil, and they are doing all that they can to achieve that objective. And they seem to be future ready. They also have products for electric vehicles in terms of coolants and fluids. And the biggest adjacency which could come in the future is the play on data centers, in which BP, their parent, is extremely strong. So data centers need to be extremely cool, and you require coolants for data centers, which Castrol is readying for the Indian market at this point in time. So suddenly, the company is EV ready. Suddenly, the company can have adjacencies from data center, and the core business itself is beginning to fire now. And the company has a 3% dividend yield in Nifty when Nifty is at around 23, 24,000 levels. So what is there to lose? So obviously, as cliched as it may sound, the rule number one is don't lose capital. Second rule is don't forget rule number one. So in the case of Castrol, the chances of losing capital seemed very minimal for the entry price that we were paying. The rest of the valuations, the market will take care eventually in the future. Another pick is Mayur Uniquoters. We entered around 491 levels. So Mayur Uniquoters is primarily catering to two industries. One is auto, another is footwear. There was a point in time when footwear was doing exceedingly well for Mayur, whereas auto, to gain entry into OEMs, especially in the export markets, was taking a lot of time. The gestation period was longer. So auto was kind of not firing. Then you now have a situation where the blue line, which is the auto line, has kind of surpassed the red line, which is the footwear line. So blue line has taken off, meaning that whatever hard work that they have put over the last 10 years on the auto business, the fruits of it, we are now obtaining because the company is now exporting a lot to the auto majors, including the likes of BMW, etc. But at the same time, the footwear has going through a bit of a slowdown because of BIS, Bureau of Indian Standards, which has led to a huge inventory buildup in the footwear industry. So our belief is that over the next, say, 4 to 6 quarters, once the footwear industry also comes back on track, along with auto, then there is a significant scope for the company to do meaningfully well, given their capabilities and capacity available. Amar Raja batteries, our entry point was around 997. and this was trading at a significant discount to Exide for a very similar EBITDA and PAT level. Exide's market cap was almost 2x that of Amar Raja at one point in time. So our theory was that the discount will revert to normalcy. So here, if you look at the table in the bottom, they seem to be regaining the lost market share. So Exide at one point in time had a 61.7% market share, and Amar Raja had 38.3% market share. So over the last 5 years, they have gained almost 200 bips market share, while Exide has lost almost 200 bips market share, and they are also getting future ready with setup of lithium ion gigafactory, etc. But very simplistically speaking, Amar Raja was trading at 50% the market cap of Exide for similar level of uh, for similar level of PAT and EBITDA. So at some point in time, this discount should actually narrow. So that was our thesis for entering into Amar Raja. So this is how generally we look at stocks. We look at we do our stock selection, etc. So in terms of performance, this fund has done meaningfully well. This fund has majority of the holdings in mid caps. When I say majority, around 60-70% would be in mid caps. There'll be 20% in small caps, and about 10% we toggle between cash and certain tactical large cap stocks as well. So post COVID or from pre COVID level onwards, this fund has been doing okay. So currently we are overweight on capital goods, FMCG, automobiles, etc. But this is a very incidental thing. So we don't really look at how much should be the capital goods weight and then accordingly buy. This is just an outcome based on our stock picking. This is not this is incidental. This is not something that is designed. It's just an outcome basically. Yeah. So the portfolio, in terms of fact sheet, we are roughly looking at a 17% earnings CAGR for the next couple of years. The portfolio PE ratio is around 21 times, and our churn is about 28%. So we are not a very high churn kind of a portfolio manager. So we churn about 25 to 28% in a year. And max drawdown that this portfolio has seen so far is during the COVID time, which was around 35%. When the index actually drew down by almost 38%. So we fell about 300 bips lesser than the index. Okay, so maybe I'll halt here. And Akshara, would you like to move to the Q&A now, or?
Yeah. So I just wanted to ask one question. Will you be explaining your other two strategies here, or only the emerging blue chip one?
Only the emerging blue chip, yeah.
Okay. So can you just finish off explaining the emerging blue chip ka part, and then we'll jump out of the Q&A. What do you say?
No, I'm done with what I had to explain. Basically.
About the fund.
Yes.
Okay, then we'll jump into the Q&A.
Sure.
And of course, then whenever it's required, you can open your PPT.
Sure.
And to start off with, we never really touched upon the global market as such. So if I could ask a question on that, how do you read international markets, and what a significance has it has on the Indian market?
Yeah, thank you for that. So global markets gives you certain trends which can play out in India with a bit of a lag. So it is, we don't invest in global markets. We can't invest. Our mandate doesn't allow us to invest. Having said that, we track almost 100 plus international companies because tracking those companies gives you an idea in terms of what can play out or pan out in the Indian markets over the next few years or something like that. Even in the short term, it gives you a bit of a clue. So, for example, there were machine tool companies in the US which was giving excellent profit growth and excellent guidance during 2021 period. So this was like a giveaway because somebody like a Carborundum Universal supplies a lot of abrasives, exports a lot of abrasives to machine tool companies. So you knew that Carborundum would do well just by looking at the machine tool companies' results in the US. Similarly, multinational companies like Linde, Hitachi, and very many other multinational companies, they have very minimal interaction here, as the Indian subsidiary. But globally, they talk a lot. So you kind of get to know what kind of technologies they are present in its entirety and what can come to India, their priorities for emerging markets, including India, etc. So that kind of edge you get when you track the international markets. So one of the main reasons for buying into Castrol was because we tracked Hertz. So when
Okay.
Hertz made that announcement that they are reducing the fleet of electric vehicles, it obviously meant that lubricant companies should obviously do well sentimentally also. So that made us get into Castrol. Similarly, if you look at Pepsi always reports results at least 7-8 trading days before Varun Beverages reports results in India, right? So and Pepsi exclusively talks about the how the emerging markets are done. They have a line or two about how India has done. So almost the result is out in front of
Hmm.
you, right? So all you need to do is just track these things, and you get a fair idea.
So with that, there is one follow-up question. How do you look into this? You've now spoken about the global markets. So what is your outlook for the Indian market in the medium term? In the medium term outlook.
See, it is going to be extremely stock and sector specific. It's very difficult to take a holistic view because uh, you know, uh, you can have two different fortunes for two different industries, right? So you've had defense, railways, and PSUs having a rocking last 12 months. But if you look at pharma, chemicals, agrochemicals, FMCG, private sector banks, these have not at all joined the party. See, there are broadly two types of corrections, Akshara, okay, in the market. So, first type of correction is what we saw during the Great Financial Crisis, what we saw during the COVID fall, where there is a significant cut in the prices of stocks for say 2-3 days continuously, and then a kind of a bottom, a base is formed from where on the next leg up starts. Although this kind of correction feels and looks very scary and tumultuous, it's any day better than a grinding time correction. Okay,
Okay.
so if someone had invested in Asian Paints in 2021, they have had 0% return in arguably one of the best bull phases in the market. So it is very difficult to give a holistic market
View.
correction or lack of it. But sectors, it depends on the sectors. It depends on the stocks basically.
Yeah, when
So
you talk about sectors and stock, I mean the whole PPT was very stock specific, though it is not, it's just for illustration purpose and nothing to take on the investment recommendation side of it. Because you are more into mid and small cap stock pickup. So if I just want to know if there's any potential, how do you identify a potential multi-baggers apart from what you've spoken about in the PPT? Where do you see, which sector do you see coming up with a potential multi-baggers?
see, nobody knows what will kind of become a multi-bagger on day one, right? So multi-bagger thing is a bit of a journey, right? Uh, so how we identify is basically, the uh, uh, typically what we have seen is that whenever there is a behavior change and people opt for different kind of products and services, they have been significant wealth creators in the past. So, for example, pre 2008 in India, most of the buildings used to be installed with galvanized iron or copper pipes for their plumbing, internal pipe, external pipe, underground pipe, sewage pipe. Everything used to be galvanized iron or copper pipes. Then the era of PVC and CPVC came. So the ease of installation for PVC and CPVC was extremely high, and plumbers just took to it like a child in a candy store, and the rest is history. So you had the galvanized iron and the copper players kind of losing volumes to PVC and CPVC. So a 300 crore, 350 crore market cap company like Astral became a 45,000 crore market cap company because they kind of were able to gain market share from a different segment. So similarly, we have to keep looking at such changes basically. So we are seeing uh, a situation where, let me give you an example of say furniture, for example.
Mm.
How would your grandfather have bought furniture, Akshara? Say 25 years back, he would have called a carpenter home. He would have given the
Yeah.
job work to the carpenter. So the carpenter would have taken the job work, and then after multiple follow-ups, he'll come back to your house with a cot or a table or a chair, which will be extremely heavy. It will be very difficult for two people to lift that furniture. And it had a shelf life of 30, 40, 50 years,
Solid.
passed on generation after generation. That's how the furniture was being bought. But today, if you look at the women force participation in the labor, it's gone up exponentially. So both husband and wife are working, so there is paucity of time. So there's time only during weekends. So now people are very happy to buy factory-made, ready-made designs. There's no time to engage with a carpenter. So when IKEA came into India, everyone was skeptical about it. They said it's made for Europe, it's very fragile, India may toot jayega and all that stuff. But today, just with 4 stores, IKEA has already crossed a 2000 crore revenue mark. I've spent a lot of time in IKEA Bangalore just to observe the consumer buying behavior. So why am I saying this? So the current furniture is typically made with what is called as MDF. So if you look at the volume growth of MDF, it's greater than the nominal GDP growth. This is the first point I mentioned when I started the call, that categories which grow above the nominal GDP have the potential of becoming wealth creators, or in your language, multi-baggers.
Right.
So, what happens is that MDF is growing greater than GDP, but it is taking market share away from plywood. So your plywood is actually growing at less than GDP. So your plywood growth is hardly 5-6%. Your MDF growth is around 15-16%. So this transition, similarly, in automobiles, you have the industry growing at X percentage, but you have the SUVs and the mini SUVs growing greater than industry, and hatchback is growing less than industry. So this is because of the change in the preference of the customer, basically.
Okay. Basically the change in consumer consumption,
Exactly.
that in turn changes the value in the market as well.
Correct.
It's very well said, a very well definition given for multi-baggers, I would say that. And moving on more specific to your fund or strategy, which is like emerging blue chip. It is widely diversified, and it has a very low churn rate. Like when you said it has just 28% of churn rate, which is comparatively low. So when it is when it is more diversified, don't you feel the timing effect is a risk to this portfolio? Like, if at all, if there is any instance that you could come up with?
We love our diversification. We are a diversified manager. We believe that the concentration creating alpha is a myth.
Okay.
So there is nothing to prove that concentration creates alpha. Okay, so it's a very American concept which has been retrofitted into the Indian conditions. The CFA textbook says that you hold 25 stocks. Anything more than that has no impact or nothing like that. So I will just give you an example of two indices. So you have the BSE small cap index and then the Nifty 250 small cap index. As the name suggests, the Nifty 250 small cap index has 250 stocks.
Yes.
Any guess how many the BSE small cap index has? Constituents, Akshara?
No.
BSE small cap index has 950 stocks.
Okay.
So, but if you look at the performance of BSE small cap and the Nifty small cap 250, the BSE small cap has in fact done slightly better than the Nifty small cap 250 in many kind of timelines. Secondly, so despite having 4x the number of constituents in its index is nothing but a portfolio basically.
Yes.
Despite having 4x the number of constituents, the BSE small cap index has done better than the Nifty small cap 250 index. Secondly, you're looking, as I'm an active fund manager, I can commit two types of errors, Akshara. The first error is error of commission, where I buy a stock and the stock falls, say 40-50%. That is error of commission. So when the investor or the client opens the portfolio statement, he or she can see that I bought the stock, it's down 40-50%. Maybe I have committed an error in the entry valuation, so on and so forth. The second error is error of omission. Error of omission is something that I look at a particular company, for some reason I don't buy that company, and it goes on to become the next Amazon. That is
Okay.
error of omission. So that you will never get to know as an investor or a client, but I will know. So what keeps me awake at night is not error of commission.
Error
It
of
is error of
omission.
omission. So despite the best of due diligence, I am going to have 2, 3 accidents in my portfolio over say 4, 5 years. Whether it is a concentrated portfolio or a diversified portfolio, I'm okay with those accidents. I'm managing those accidents with my weights and with my diversification. But what I don't want to miss is error of omission, where I
Okay.
miss out on newer sectors, newer industries, etc. So I need that comfort level, and public markets gives you that option to look at very many industries and sectors. Your hands are not tied, unlike a private equity where you have to deal with say only say healthcare or a tech or a star. There's nothing like that. So from a restaurant company to a defense company, I can look at anything. That's so, like Warren Buffett says, click of a button, you can just get out of the business if you don't like it. So why not take advantage of that? And why should one have this Superman approach that I can make all my money in 15 stocks or 20 stocks? No, it's not. You can still make a lot of money if you hold 35 to 40 stocks. Nothing wrong in it. Having said that, 80% of the client money is anyway in the top 25 to 28 stocks
Okay.
in our case. So to that extent, it's concentrated only. We have a tail. We have a fairly longish tail. In my portfolio, the tail plays as much an important role as the head. So tail, the origin of the river Ganges is Uttarkashi, right? So the
Yes.
origin of a multi-bagger in my portfolio is from the tail. It is from the tail that the stock moves from the bottom to the top by virtue of two things. One, we add more weight into that stock at a later point in time, and other, the market action itself takes the stock up. So we don't know on day one if the stock is going to be a multi-bagger. So your conviction on a stock on day one is very different than your conviction on a stock on day 300.
True. I could get a different perspective over it. And I also understood that the investor who invests with you can have a taste of the concentration part, also the diversification part also,
Yeah.
to an extent. So thank you for that. And moving on to it, when you talk on the error of omission part. So being the blue chip, emerging blue chip portfolio being the longest in the NAFA history, ma'am. So it is successfully completed 8 years. Is there any one stock that you have retained from the beginning?
We've had Astral, which we've been holding since the beginning of our portfolio. We've had companies like Divi's Lab, which we've been holding from the beginning. We've also had Green Panel, which of course got listed only in 2019, but since the time of its listing till date, we are holding. So we do have a lengthy holding period in many of these kind of stocks, basically.
Okay, so because of time constraint, let me take few questions from the audience as well. I could see n number of questions falling onto the podium. I might not take everything, so let me take few. Probably the one. What is your current valuation? Your current view on valuations mid and small cap space? If you want to take that.
Uh, So it is definitely bubble in certain segments, and definitely you can still find companies with cash flow yield in double digits in certain other segments. So it really depends on what you are looking at. Having said that, see, people when they talk about mid cap and small cap, they kind of compare it with Nifty and say that Nifty has not done much, whereas mid cap, small cap is flying, which is definitely right. But having said that, uh, we need to kind of look at it in a different way. So if you're an Akshara, if you're an early 2000s investor, okay, early 2000s, like good 24 years back, just by being present in the top 30, 40 names, you could create your wealth. So you could just throw darts in those 30, 40 names, you would have created wealth in the Nifty stocks, right? Because you had two-wheeler penetration in India was very low.
Hmm.
Four-wheeler penetration in urban India was low. We were still underbanked as a population. So whereas in the mid cap and small caps, those were untouchables at that point in time because the corporate governance was questionable. There was lack of tax compliance, very high unorganized segment. and so on and so forth. But you move to say 2024 currently, your two-wheeler penetration has gone through the roof. Your four-wheeler penetration in urban India has gone higher. After this Jan Dhan Yojana and everything, every Indian has a bank account now, almost every Indian. But Nifty still has the same stocks.
Okay, that is a good comparison.
Are the real large caps in Nifty or outside of Nifty? So what is Apple's turnover in India today? It's 70,000 crores. Microsoft's turnover in India is about 30,000 crores. Amazon and Google will be around 50,000 crores. John Deere, Caterpillar, all these companies have doubled their turnovers. These are all numbers which are greater than Cipla, Sun Pharma, Hero, Bajaj, and all these Nifty 50 companies. So the real large cap growth is coming outside of Nifty. But whereas what has happened in the mid and small cap segment, better corporate governance, unorganized to organized movement, better tax compliance, new sectors and new stocks getting listed. So obviously there is more interest level there, right? So that is one of the reasons why there is a significant amount of interest. I'm not saying that we shouldn't be cognizant about valuations, and that is entry valuation determines your final returns. No two ways about it. But these are some of the changes that we are seeing in the mid and small cap segment.
Thank you, sir. Because of time constraint, we had to come to the end of the session. Though I couldn't take all the questions from the audience, so I'll be mailing those questions to you, and I would request you to take it offline. So we can answer them and send it to the respective person. And I must say that was a big fan following for your PPT as well. So if you allow me to share it, I would share it with those people who have asked it for.
Sure, we'll have it sent to you, Akshara. Thanks a lot.
Thank you. So thank you for your time for on Friday evening. I felt like more of a research person talking to me, and it was everything which was explained was it was bifurcated into bits and pieces, and it was very understandable on a layman's term. Thank you for that, sir.
My pleasure. Thanks for it was a pleasure interacting with you and your investors. Thanks a lot.